Again, I thank everyone for joining us. And Dr. Marty Gillen is with us, and she will be presenting today on investing basics: where, when, how, and why. And Dr. Gillen and I have presented at numerous conferences around the country, and I know she's a terrific presenter. She is actually, she's at the University of Florida right now, but she's also teaching financial social work using our curriculum as an online distance course at the University of Kentucky. And she has so much to share with all of you today that she really didn't want to do an elaborate introduction other than to say that she's an assistant professor and extension specialist on family, youth, and community services at the University of Florida. Before I turn the presentation over to Dr. Gillen, I just wanted to get these slides working. Okay, I'm Rita Wolfson, so I'm usually your presenter, but today I am hosting this for the Center for Financial Social Work. And I wanted to just share with those of you who are new to our free financial social work webinars a few points about financial social work. But I had thought that I had, okay, let's go ahead. Financial social work is an interactive, introspective behavioral model which is heavily psychosocial. It facilitates the choice to take greater responsibility for creating a better personal and financial future through our model of ongoing education, motivation, and support. And in the next week or so, we will have our new ebook, Financial Social Work Basics and Best Practices, which will be free and downloadable from our website. And in it, we talk about the differences between basic financial literacy and education and the financial social work model. Here's the slide I was looking for. I'd like to congratulate the first 50 people that registered were promised a financial social work tote bag. And Olga, are you there?
Yes.
Okay, my assistant Olga is on the call with us, and you will be receiving an email telling you that you're among those first 50, and you will be receiving the tote bag in the next 2 weeks. So thanks for being the first 50 to register, and hopefully for being with us here today. So that slide was out of place. We'll just do another 2 slides, I think, on financial social work, which is, as I explained, very interactive and introspective. And it's a psychosocial model, which matters because until and unless behavior changes, nothing changes. And so at the core of all of our work is, and our mission was on one of our slides, it is all about helping people to create sustainable long-term financial behavioral change. Taking greater responsibility for your financial future requires more than new financial skills. And I think today's workshop is a good example of that. Financial stability, it is a very individual, personal, emotional choice. And what that means is that we have to make it on a daily, weekly, monthly, sometimes minute by minute, and hour to hour. Those are the choices of how we'll spend and what we do with our money every day. And financial social work ultimately is about change, help, hope. It's very personal awareness growing. It's about setting personal and financial boundaries, reducing the stress that money so often creates in people's lives. It's about knowing your worth and not selling yourself short. It empowers and inspires. It's about lifting people up because, as this, one of my very favorite graphics shows, ultimately we want to help people to be at peace with their money. And that doesn't happen until you take control of your money in order to gain control of your life. So at this point, I am going to turn this webinar over to Dr. Gillen. And we are going to hope that this goes very smoothly. We have practiced this and had some success and some not so great success. Okay. So now everyone should be seeing Dr. Gillen's screen.
Okay, thank you all for joining us again. I'm going to be sharing a little bit with you today about investing basics, so the where, the when, the how, and the why, all regarding investing. So just kind of give you an overview of what we'll be going over today. So investing versus savings. Are you ready to invest? When the best time to invest is? Starting early versus starting late? Whether or not you take an active versus a passive role in investing? Where's good places to invest? And how you get started with investing. So the first thing we're going to talk about is investing versus savings. So it's definitely very, very important to distinguish between saving and investing. So with investing, you're really taking calculated risks in an effort to increase the returns on your investment, meaning you're taking some lump sum of money and you're really trying to increase it. And along with that, again, comes some risk. So you're really trying to put your money to work with opportunity and the potential to grow and increase it more than a savings account's going to. You know, with savings accounts, you get minimal interest, but you get lots of security. So investing, again, is a very different animal in that you throw into it the risk, but you also have a greater ability to increase your money through that. So to think about, are you ready to invest? So there's a few things that you need to think about before you begin investing. So the first thing you need to do is assess your current financial conditions. So think about doing a balance sheet. So looking at to see if your debts are under control, so looking at your assets compared to your debts. Doing an income statement to look at your income compared to your flow, to your expenses and the outgoings. You know, thinking about whether you have enough saved for emergency. And then really wanting to put a working budget in place. So it's really not going to benefit you if you have your money tied up in an investment, if you're living paycheck to paycheck, and if an emergency strikes. So again, you really want to hold off on doing this investing until you have all of these pressing debts taken care of. And again, you might also want to think about checking out your insurance needs, making sure you have appropriate insurance levels. So doing these things are really going to help to put you in a better position to start investing. And just to clarify a few things, the way we're going to be talking about investing today is from an investing security standpoint. I'll address 401ks, 403bs at the very, very end of the presentation. So I'm by no means saying don't take advantage of your employer's plan and that kind of things, but this is more investing in securities kind of on your own in addition to what you're already doing from an employer standpoint. So the next thing you want to think about is your investment goals and your plans. So really, you know, what is your overall goal for investing money? Because a lot of that's really going to drive where you can put it at, you know, how do you need to get to it, how quickly, so the liquidity, and then how much money are you going to need. Obviously, if you're 35 and looking at retirement investing, you know, that's probably going to be another 30 years down the road, so that's going to look different than if you're wanting to invest to have money for a house in 10 years or other types of investment. You know, maybe you're wanting to invest to save money for a child's education. So again, that's going to look very different depending on your stated goal, when you're going to need the money, and how much money you're going to need.
Dr. Gillen, Gillen, I know you're so excited and you have so much information to share with everyone. I know you told me you were concerned whether you'd get through it all, but we have plenty of time, so I think you can slow down a little and enjoy the presentation with us.
Okay, I'll try, but please remember to let me know if I don't.
Okay, thanks.
Yeah, I tend to get very excited and go really fast when I'm talking about something that I love. And finances and investing, I love it all. So I'm just very motivated with it and tend to go very fast.
I know you are, but we're very excited to get this information from you. And I think everybody on the call may want to take notes and certainly wants to hear everything you have to share. So thank you.
Okay, So let's move on now to thinking about the factors that affect your investment. You also need to think about this when you're planning where you want to put your money and, again, how long it's going to be till you need it and all of that. So you have three primary key factors to think about. So the rate of return, meaning how much are you going to make off this investment, and some of that is kind of in fluctuation with market. The taxes, how much taxes are you going to have to pay on this investment? And then also the associated risk. All investments, again, do have some type of risk associated with it. So you really need to think about that. And when thinking about risk, think about what's your risk tolerance. Are you willing to accept more risk for hopefully a greater return, knowing that you might not make that much? Really, what are you willing to accept? So there's a few different types of risk that we're going to talk about. So you have interest rate risk, inflation risk, business risk, financial risk, liquidity risk, and then the market rate risk. So the investment and risks associated with that, again, is going to deal with a lot depending on the market, but thinking about what you expect as far as returns on your investments. What can you earn on one return versus another type of an investment? And again, really thinking about the risk being related to that potential return. So the more risk you assume, generally the greater the potential for the reward, but also the greater the possibility of losing your money. So you really want to think about that combination. And then thinking about inflation risk, if it's something that, you look at an average savings account and you might earn 1% if you're lucky on that. And inflation's growing at about on average 3% a year. So in reality, you're not really earning anything on that savings account. You're actually losing 2%. And that's getting at what inflation risk is. So with the rising prices, will that really erode your purchasing power from that investment? And then looking at business risk. So really the actual business risk of that business, so the effects of good and bad management decisions. Financial risks, so those associated with the use of debt by the firm. Liquidity risk, again, your inability to liquidate quickly and at a fair market price. You may be able to liquidate quickly, but is it really at the best price you can get? So again, all of this really plays into thinking about your overall goals and your plan, when you need the money, what it's for, and all of that, in determining where you really want to invest it. And then, when you're thinking about your risks and more, you've got to think about your emotional and your financial capacity to really be able to ride out the ups and downs of the investment market without really panicking over, the value when some of it does go down. So risk tolerances, they vary widely, and yours may not even be the same as your friends or your spouse's. So there's lots of personality factors that go into that, and a lot of it's also dictated by your stage in the life cycle. So if you're not going to sleep well at night when the principal value of your investment goes down, you should really look at selecting something that's less risky, so something that's lower risk. But on the other hand, you've got to really realize that the investments which guarantee the safety of the principal are not going to grow as quickly or maintain that purchasing power in the times of inflation over a long time span. So in reality, it's really necessary to take some risk just to maintain purchasing power. But really the question you need to ask yourself is, what kinds of risk are you willing to take?
Marty?
Uh-huh.
Do you have the polls?
They are not working.
Okay, why don't you go ahead and just send it over to me, and I'm going to do the risk tolerance poll, and let's get everybody involved for this segment.
Okay, you should have it back.
Okay, thanks. So what we're going to do here is, I love doing polls on our webinars. It gives everyone a chance to get involved, and I am going to ask you to consider your risk tolerance from a bit of a different perspective. Not identifying which category, as Dr. Gillen did, but where you think you fall. How much risk are you comfortable with? It's a really important piece of investing, knowing the level of comfort you have. Okay, about 50% of you have voted. Come on, we'll take a few more seconds and then I will share the response with you. Okay. Very interesting. I will say that we're stronger in the middle than we are at the two ends of the continuum. Okay. We're up to 79%. Anybody else want to vote? 80%. And 5, 4, 3, 2, 1. We had 82% of you vote. 84. Okay. Now I'll close it and I will show you the results. And I would fall probably right in the middle myself. What about you, Dr. Gillen? Where are you? How tolerant are you?
I'm very high, probably.
Probably. That's because you know what you're doing so well. Okay. So, low. Okay, I probably would be in neutral.
Maybe I'd be more in the high category. Maybe not the very high, but definitely not low.
Okay. So, let's go ahead and I will close that poll and I will turn it back to you. And thanks everybody for those of you who participated. Okay, so you should have it now again, Marty.
So are we good now?
Mm-hmm.
Okay. So now thinking about different ways that you might be able to reduce some of this risk, especially for some of you that are on the lower end of the risk spectrum, and even for those in neutral, but we all really in reality want to reduce any risk that we possibly can. So diversification is one of the biggest ways that you can reduce that overall risk. So just like all of the other areas in life, you really don't want to put all your eggs in one basket. So you really want to think about diversifying your investments, and that really should help that risk decline. And what I mean by diversification, it's not that you're maybe even diversifying among different types of stock, which you want to do that, but looking at different mechanisms for investing. So you have some in mutual funds, you have some in stock, you have some in bonds, you've got maybe even a money market account going on. So you're really looking to diversify kind of that overall portfolio, and then really looking at your asset allocation. And you also want to think about going in at probably at least yearly and really looking at that, because as the market goes up and down, your asset allocation may shift between your different types of investments. So for example, if you have a conservative portfolio, you may be looking at about 20% stocks, 40% bonds, and 40% in cash options. And like I said, as you're going through the year and things shift and one goes up, one goes down, you need to look at really rebalancing that to get it back to where you're comfortable with every time. You know, compared to a more aggressive portfolio, might look at 75% stocks, 20% bonds, and maybe 5% for your cash options. So really thinking about the way you allocate your portfolio, that's going to be one of the really determining factors in how much money you're going to bring in from your investments. So again, very important to at least yearly go in and look at that and make adjustments if necessary. So the next thing we're going to talk about is when the best time to invest is. My best advice to you is to start early. So the earlier you can start with this, you're going to have compounding on your side, and we'll talk about how that equals more money and how time really is your friend. And then also generally when the market's down, you can buy more shares of stock, for example, than when everything's skyrocketing. So a lot of people go running out when it's down, when really they actually should be running in or staying in to be able to make back what they've lost over that long run. So we'll go through a few examples of starting early versus starting late and kind of how that looks. So a lot of people use the example of Ron and John. So we've got Ron and John, twin brothers, both are age 21. Ron invests $2,000 each year for the next 10 years, and then he lets the money sit until he's 55. So he invested a total of $20,000, so just $2,000 for 10 years and just lets the money sit. Doesn't put in another penny. Then we have John, on the other hand, who waits until he's 35, and he invests $2,000 a year until he's 55. So he's invested for 20 years compared to the 10 years, and he's put in double the money that Ron has put in. So just to come up with a simple example, so if they both earn 7% per year, who's going to have the most money? So again, time really is your friend. Ron is going to have the most money, so it's going to grow to almost $30,000 after 10 years, and then he's just going to let it sit there for another 24 more years, and he's going to have over $220,000. Compared to John, who's put in $2,000 for 20 years, so he's put in twice as much, and he's only going to have $98,000 at the end. So that difference is going to be over $100,000. So John would have to increase his annual contribution by $2,285 per year just to catch up to Ron. So again, really, time is your friend, and you really need to start doing this, whether it's investing in securities on your own individual level or whether it's truly just taking advantage of your employer's 401k or 403b. It truly is your friend in that. So the reason
Also, Marty,
uh-huh.
if there's a match, if there's any match where you work
Mm-hmm.
to your retirement savings, that if you don't do that, you're really just leaving money on the table, right?
Yeah, I mean, it really is free money. When I was at the University of Kentucky, I put in 5%. They put in 10%.
Wow.
Yeah, a little different when I come to UF. They put in 10.42, and here you wasn't required to put in anything, and that's changed a little bit now to where they put in 7.42, and the employees are required to put in 3.
Hmm.
So again, the 10%, the 7.42, that's just free money, and I think about anybody would line up to get free money if somebody was handing it out on the street corner, and this is your one opportunity to be able to get that.
So find out about it, folks.
So some strategies, again, starting early, it's always to your advantage, and that's because you have this time for compounding. And I'm going to give you a couple examples that walks you through that. And then also using payroll deduction if you've got access to that employer-provided plan. Once you set that up, you actually have to take more steps to stop it, so you're less likely to stop up something that's automatic. And that goes, if you set it up to put $50 a month in your savings account, or maybe you invest in a Roth IRA and they just take that directly out of your checking account every month. Again, research shows that once you start it up and you would actually have to take more steps to stop it, you're actually going to let it go. And then paying yourself first. So thinking about yourself as a line item on your budget. How can you meet your goals and meet your savings needs? And again, really taking advantage of any tax advantage savings. So again, Roth IRA makes a lot of sense. If you're an average student and have $3,000 in income coming in, you can sign up for one of these. And also young employees, it's a really, really good mechanism. You take money that you've already paid taxes on, you put it into this Roth IRA, and you can do it for as little as $25 a month. And once you take the money out later on down the road when you meet the age qualifying event, or if it's to buy a home that also qualifies, or educational expenses, you don't pay taxes on that interest income. So the money that you've made, you never pay taxes on that again. So again, just one real easy mechanism to think about. So I've got a few graphs to show you the value of starting early. So this shows investor A, B, C, and D, and they both contributed $5,000 for each of 10 years with no additional contributions. Now this one does assume an 11% of return, which is pretty big, but it does kind of show you the differences as far as the values that they would have had. So investor A, for example, started out at age 25, and you can see at the end they had $787,000. And again, only put the money in for 10 years. Investor B started at age 35 and has about $360,000. Where investor D started at 55 and still contributed over a 10-year period, but again only has $83,000. And that's really showing you that time again is your friend, and compounding really, really does add up. So again, compound interest helps you build your wealth faster. So you're basically putting this money in and it just keeps rolling over, so you're earning interest on interest. So another example, if you deposited $5,000 in a bank at 6% interest for a year, it's going to earn about $308 if the interest is compounded monthly. So in just 5 years, that $5,000 is going to grow to about $6,700. Another graph that shows you starting early compared to starting late and the compounding. This is looking at it on an 8% return. So you have Tim and you have Sally. You've got Tim that stops contributing at the age of 25. Sally doesn't begin contributing until the age of 46. And then it looks at it over the long haul up until 65, where you can see Tim has almost $500,000 and Sally has about $200,000. So again, same amount invested, but looking at that difference of just really letting it sit there for the long run. Another one that shows you with $125 monthly deposits and looking at various interest rates, so 10%, 8%, 6%, and then no interest, and really how just letting it sit there really does add up. And again, the compounding is the way that you do that. Now I do have, when I teach this in classes, lots of people ask me, why do you see such high interest rates as far as 10%, 11%, when in reality the interest rates are not going that high, or your investment rate of return? And there is no simple answer for that. I personally think, there's a lot of textbooks that like to show you can see the bigger differences when you use higher rates. So a lot of it really goes at that. So thinking about, even if you've not started, it's never too late to start. So what's a person to do if starting later? So even if you can't save the full amount, think about taking it just in small steps. Even a partial savings each month can really make a difference. And really just simple changes in everyday spending can truly add up to a lot of money over time. So when you're thinking about planning for retirement, every dollar really does count, especially when you think about saving in a tax-deferred vehicle. So to give you an example of small savings that add up, if you take a $4 latte, and instead of drinking that, how about a $2 cup of coffee? So that's about a $60 a month savings, so $720 a year. Over 20 years, that could amount to more than $24,000 in additional savings. If you regularly put the money in there every month and looking at even a moderate rate of 5% annual return. Now again, average savings accounts is not going to get you that. So you'd have to investing, the money. Some more examples. So thinking about it from an individual retirement account standpoint with an IRA. So if a person makes an additional $1,000 a year contribution to an IRA starting at age 50, by the time they reach 70, which is the last year you can contribute to a traditional IRA, that person would have saved an additional $34,000 toward retirement. And again, that's just $1,000 a year over the 20 years with a 5% rate of return. Now, if the person took it a step forward and fully funded the IRA, which would be $6,000 a year, so anybody can contribute $5,000, but once you reach age 50, you have the catch-up provision where you can contribute $1,000 more. So that would mean an additional $208,000 for retirement at age 70. So the $6,000 a year, the 20 years, and again, a 5% rate of return. So please don't lose heart with all of this. If you haven't started, it's time that you can set a plan in place and really think about it. Even if you're still age 50, 60, there's still ways that you can start saving money and look at it, and it really, truly will add up. Especially, if you think of longevity and how much longer individuals are living and how much longer the money's going to have to last, it is really not too late to start saving at all and start investing to be able to turn that round. The rule of 72 was another one I wanted to go over with you. So that's an approximation to determine the length of time needed for your investment to double. So it's a very simple calculation. So let's say you have a savings account with $5,000 deposited in it. If the interest rate on the account is 6%, you would literally take and divide 72 by 6%, or whatever your interest rate is, to find approximately how long it's going to take your money to double. And in this case, it's going to take 12 years, and you would have about $10,000. And again, that's if you make no more additional deposits. So again, one kind of easy way to look at how long it would take you to actually double the money.
One second. I just want to add that although, this is a webinar on investing, it's also important to understand that the rule of 72 also applies to debt, so that if you're not paying your debt, your debt will still continue to grow. And the same is true for compounding interest, right, Marty?
Correct.
So it's really a choice of, do you want your money working, do you want those realities, and do you want your money working, those realities working in your favor with investing, or certainly not in your favor when you have debt. Thanks.
So it's really looking to see whether your money's working for you or if that debt is working against you.
Yes, it is.
Okay, so let's move on then to talking about your investment philosophy. So looking at whether you're a conservative investor, and conservative investors typically are really looking at preserving the capital. And then whether you're a moderate investor. A moderate investor is generally considered to be risk indifferent, and I know several of you put neutral in there, so you'd probably be likely to be moderate investors. And then aggressive investors are usually those that are the true risk seekers, that are okay if they lose some of that capital. It is not going to make or break them. They're okay with losing some of that and being able to take that kind of to the next level to try to seek that even greater return.
Marty, I have a poll on this. If you want to send it back to me, I think I'll do 2 polls here so that we don't have to keep going back and forth. But let's give everybody a chance to participate here. Okay.
You have it back now.
Thank you. Okay, so let me show. Let's try this poll, and then we'll do the poll on your investment philosophy. Okay. So that poll is open. So when it comes to investing, I am, which of those are you? Interesting. Okay, 56% of you have voted. %. Come on, people. Let's join in. Remember, this is anonymous. Okay. So 78%. I don't suppose you want to give me 100% on this. Okay. We'll close it in 3, 2, 1. And now I will share it with you. Okay. What do you think, Marty?
So about half of the people are either novice or experienced at it. That's interesting.
It is
about
interesting.
43%.
That's very interesting.
53%, sorry.
Okay. So, you have things to teach these people or what, Dr. Yellen? I know
They
you
might have stuff to teach me.
Okay, well, let's do the other poll that I have. What is your investment philosophy? We'll launch that one. And this is what you had just gone over. What do you anticipate, Dr. Gellin? Where do you think the most people will fall?
I'm going to go with moderate.
Probably not a bad guess. And we're at 77%. And see if we can get into the 80%, and we'll close it. Nope, nobody wants to take me to 80% today. So we'll close it in. Okay, 80% of the people have voted, so I guess we'll close it now. And show you that you were indeed correct. Well, I guess you would be an aggressive investor, and I would definitely be a moderate investor.
I'd probably be more moderate on this terms, because when you think about aggressive, I like my capital and I want to preserve it, but I do want to look out and see how I can broaden it, but I definitely need to preserve it too. So probably more moderate on this angle.
Okay, well, while I close this and turn the webinar back to you, I will just say that uh, age has a lot to do with it, right?
It definitely does.
Okay. So you should have it back. Okay, good.
Okay, I believe I do.
Okay.
So we'll continue on talking about whether you should take an active or passive investing approach. So really thinking about whether it's active or whether it's passive really depends on your overall philosophy. And it's not necessarily that you're taking an active role in it or a passive role in your investing, but more to do with how the stocks and the bonds and your different investments are classified, and whether you're kind of buying and holding would be more of a passive approach versus actively seeking out different stocks to sell and really trying to make gains through that way. So to kind of give you an example, so statistics tell us that women live longer than men, and that's really a fact. You know, there's lots of research that points to that as far as longevity. So as long as we look at all women compared to all men, it holds true. But suppose you were trying just to pick out, you know, just the men who will outlive most women. So would you really be willing to bet your money on your ability to choose right? So an active investor, an active strategy is really trying to choose that right investment, that right stock that's really going to make them the most money. So again, they're actively really seeking out, you know, that big hot stock that they're going to be able to sell, make the most money out of it. Where again, a passive one may even be looking at mutual funds or definitely more buying and holding, not just trying to pick out that one big stock that's going to make them the most money. So again, your active investors believe in their ability to outperform the overall market by again picking stocks they believe may really perform well. So again, a passive investor really wants to own different types of stocks. So I've got all the stocks because really they think as a whole over long periods of time that capitalism really works more in their favor and they're going to receive higher returns from investing, again, more like in a mutual fund approach than trying to pick individual stocks which are going to outperform the market as a whole. So again, you know, just really thinking about which way you would want to look at it. You know, personally, again, you don't want to put all your eggs in one basket. So, you know, really being careful and mindful of your approach and how that's playing out and how that's going to work for you. As far as where to invest, I do a talk with some older adults. They're probably age 65 and older ever so often. And one of the biggest questions I get there is, where can I put my money to make money? And my answer to them is, where can you find a we return 8% a year guaranteed mutual fund? There is no such fund. So that's not to say there aren't investments that at first blush or first glance may seem to offer guaranteed returns, but you need to be very, very careful when you're looking at that. You need to make sure you're looking at the target rate of return versus a promise or a guarantee. Yeah, a lot of stuff when they publicize information, they have this overall target. It's done this well in the past. They predict it's going to do this well in the future. But again, that's not a promise and that is not a guarantee. So I really don't know of any way to guarantee you a 7 or even 8% a year or anything close, especially over the long course, several decades, which is really the time that most of us spend saving and investing for retirement and many other purchases. So again, you know, it's doing the most with what you can and really paying attention to that fine print. Again, if it says they guarantee it, you really need to look at that because very few are truly, truly guaranteed. So we're going to talk about different types of investing. So the first thing is investing in securities. So a security, a simple definition, that's bonds, stocks, and other documents that are sold by corporations, also sold by the government, to raise large sums of money for their use. So the first thing we're going to talk about is a bond. When you think about a bond, it's a form of debt, so it's a security representing a loan of money from a lender, which would be you, to a borrower, which is the business or the government, for a set time period, and it's going to pay a fixed rate of interest. So as far as investing in bonds, they're one good way to help reduce some of your risk through diversification because they do produce a steady income. And if held until maturity, bonds are a relatively safe investment with low risk. So a couple of terms that you need to be familiar with. One is par value, which is the face value or the return at maturity. So you hold it for 10 years, and that's going to be the value of it. And then also the coupon interest rate. So the percentage of the par value that's paid out annually. So generally your bond owners receive interest payments for a number of years, and then the par value at maturity. So the value of bond is the present value of the interest payments plus the present value of the repayment of par value at maturity. So kind of an example, an 8.5% coupon will pay $85 annually on a bond with a par value of $1,000. There's some different types of bonds to be familiar with. So you have corporate bonds, treasury and agency bonds, municipal bonds, and then also junk bonds. So the corporate bonds allow firms to borrow money. That's a major source of their funding. These bonds are typically around $1,000 in denominations. And then you have your treasury and agency bonds. So the U.S. government is the largest issuer of debt, meaning the government spends more than it takes in. So to finance an unbalanced budget, it can sell assets, raise taxes, or borrow more money. So the Treasury issued debt, which can take the form of bills, notes, and bonds, have maturities between 3 months and 10 years. 70% of the debt has maturities of 5 years or less. And generally the minimum denominations are around $25,000. You also have U.S. Series EE bonds, which are your savings bonds that are aimed at small investors. These generally have face values from $50 to $10,000. They can be purchased at half the face value and double in value after a specific time. And they can also be cashed in for a fraction of the total amount at any time. Many of you may have gave these to your children for Christmas or birthdays or to grandchildren, or even graduations coming up. They make a really good graduation gift. And then you have municipal bonds. So your municipal bonds are issued by states, counties, cities, and other public agencies. So for example, when a school district builds a new school, they may use taxes to pay back lenders who bought bonds. So they are tax exempt from the federal government and state as long as you live where the bonds were issued. So with your municipal bonds, any capital gains from selling early are going to be taxed. And most of these bonds have serial maturities. So basically a portion of the debt will mature each year. So they're not totally risk-free, although it's really rare that the issuers default on it. So really the biggest appeal of the municipal bond is going to be its tax-exempt status. So you'd want to compare between municipal bonds and then other taxable bonds when you're deciding if a bond's correct for you to invest in and which one. And then your junk bonds, these have low-rated bonds or high-yield bonds. So major issuers of your junk bonds are going to be new firms that have not yet really established a performance record. So along with that, you're going to have a greater risk of default. Now they do have interest rates 3 to 5% above the long-term bonds. But again, there's going to be a greater risk for default on the terms of the company. So again, anytime you have more interest that you can get, more money, the risk is generally going to be higher with that. So now moving on to stocks. Overall, there's two types of stocks. You have preferred and you have common stock. With your preferred stock, you have priority over common stockholders in the payment of dividends, but you don't have any voting rights. Common stock refers to general ownership in a corporation and a right to share in that corporation's profits. You also have a right to vote at the shareholder meetings with 1 vote per year. So to kind of walk you through some different strategies for some of that and different options. So again, a stock represents ownership in a company or a corporation. And with the common stock, you're purchasing a part of that company. You may get dividends, you may not, but they do have the option of paying that. And then also capital appreciation. Many are going to be considered limited liability. And then companies can repurchase their own stock within that. So some types of common stock are blue chip stocks, growth stocks, income stocks, speculative stocks, cyclical stocks, and defensive stocks. So all just different options. As far as looking at the value of stocks, you can look at the Dow, the S&P 500, the Russell 1000, 2000, Wilshire 5000 are all different indices that you can look at to look at the value of the different stocks, and all different ways to kind of look at, maybe which one you might want to invest in. The next thing to think about is mutual fund. A mutual fund, again, is going to pool money from several investors. It's going to buy a particular type of investment, such as a stock. So you don't really have all your eggs, for say, in one basket with one stock. You've got multiple stocks that make up this mutual fund. But when you're thinking about that, you can also buy mutual funds that are kind of industry oriented. So maybe you're investing all in golf oriented items or NASCAR oriented items, or have different themes. Maybe it's alcohol. So when you're thinking about that, and if you invest all your money in a particular type of a mutual fund, you kind of lose the diversification, because if an industry as an whole starts to lose, your money may go down, and you don't really have that diversification within that one mutual fund to counter that if it's truly invested all in one type of industry. So looking at the differences between mutual funds and individual stock and bond trading. So with your mutual funds, you do have professional management of investing. There's minimal transaction cost associated with it. And on average, you may see higher returns. And again, there's all kinds of different types of mutual funds to choose from. They even have targeted mutual funds that if you want to retire by a certain date, this is the one you invest in. Then individual stock and bond trading, it requires time, it requires expertise. Not to say that just anybody can't do it, because you can if you've got the money. It does typically have higher transaction costs compared to mutual funds. And again, if you're just picking out one stock here and another stock, you're really not going to have true diversification unless you have this whole array of portfolio. So a mutual fund, unless it's in a specific industry, is definitely one way to get you much more diversification. Other areas you can think about investing in: real estate. So having property that you rent out or rent to a business. Collectibles, so items of personal interest to collectors, so from coins to books to stamps to different sports memorabilia, rugs, ceramics, all of that could be considered an investment. I would kind of urge caution with that, because when you're thinking about that and how fast could you truly sell it and convert it to cash, well, that investment, as far as a collectible, it's truly only what somebody's willing to pay you for it at that moment in time. So you probably definitely would not want to put all your eggs into that basket as well. And then commodities, so investing in grain, livestock, precious metals, and currency is another area for investing. Now to just kind of walk through some of these different types of investments and to give you some ideas as far as risk is associated with it. So low risk is going to be your money market accounts, your CD, certificate of deposits, or U.S. government bonds. Again, you can think about a basic savings account is considered very low risk, but again, with these investments, you get lower interest and lower potential for earnings. So some safety and income investments: U.S. Treasury securities, conservative corporate bonds, state and municipal bonds, income and utility stocks. These are all generally considered safer investments. Again, they still have risk associated with it, as is any type of investment, but definitely much safer than some of the other ones. If you're looking to grow an investment, looking at income and growth stocks, your mutual funds, again, real estate. Now, we have saw a big decline in the housing market, things like that. So again, a lot of the people that bought and flipped houses lost some money in some instances, and we've seen a lot of people lose their homes because of declines in value. So again, real estate's still a very risky type of investment. And then convertible bonds is another growth investment avenue. Speculation investments, another area, high risk. So looking at options, the commodities where we talked about the grains, livestock, different things, the precious metals and gems. speculative stocks, junk bonds, and again, collectibles are all going to be considered high-risk investments. You also need to think about the factors. We touched on this earlier just briefly, but the factors that affect the rate of return on an investment. So again, that risk, how much risk are you willing to accept? And that basically means the investment fails to produce what you think it's going to, so you have a chance for loss. You need to look at the rate of return, also referred to as the yield. So looking at the amount of money the investment earns, and looking to see how frequently the compounding is adding up. Is it monthly? Is it yearly? The more frequently, the more money is going to add up. And then looking at liquidity. So basically the ease with which you can take that investment and convert it to cash if you needed to do so. Looking at inflation. Is the rate of return going to keep up with inflation? And again, any tax considerations. The Roth IRA, again, is one of the few avenues that you can put your money into and not pay taxes on the earnings if you meet all the qualifications for drawing it out. So some investment strategies to think about. Over the long term, a lot of your long-term investors, they understand market timing. They understand, you go in again when things are really low and you stay and you hold on to that. You write out anything. And if that, again, worries you, investing in some of these things that are high risks may not be for you. You really, again, need to understand that real rate of return. So the real rate of return after taxes and inflation. Something may sound really, really good up front, but if you're going to have to pay a lot of taxes and it's not keeping up with inflation, it's not going to be such a good investment in the long run. And after you look at everything and look at the true rate of return on that investment. And then again, diversification. Again, I can't say it enough, really spreading out your assets among different types of investments to really look at reducing that risk. And again, don't put all your eggs in one basket. You really wouldn't do that for anything else, so don't do it for an investment. That portfolio diversification really helps with market volatility. And then again, asset allocation. So making sure your categories are where you want them to be, at least on a yearly basis. Long-term investors also use a strategy called dollar cost averaging, which basically means they're buying an equal amount of the same stock at equal intervals. So invest $100 in eBay stock every month. So they're putting that $100 and investing in that regardless of whether it's buying them 5 shares or 10 shares versus saying, okay, I just want to buy the 5 shares every month. So they're investing equal amounts of money every month. And again, over the long haul, it's going to average out and actually be in your favor. And again, the buy and hold technique. So buying a stock, hold on to it for a number of years. You really are anticipating long-term economic growth when you're doing this. And really during that time, hopefully you're going to invest in a stock that's going to pay dividends. And again, hopefully it's going to go up and appreciate in value. As far as buying and selling investments, you definitely need a broker to be able to buy and sell investments. There's different types of brokers that I'm going to go through briefly. So you have full service broker, you have a discount broker, and you have investment advisors. So there's different types of brokers even within that realm. And you definitely want to make sure you pay attention, you're asking good questions. They all have different commissions, for example. So your full service broker is going to be commission based, give advice, execute trades. A discount broker is going to execute your trades, but they're really not going to provide any advice, but they're going to be cheaper because of that. And then you have your deep discount brokers, which again are going to execute trades, but are going to be about 90% less than the full service brokers. And then you have these online brokers that you can easily go to, but when you're thinking about it, they're truly just going to execute your trades. They're going to give you no advice. There's no person to call or no person to go in and see if you have questions. So kind of the key to think about that is how much do you need to talk to somebody, because you truly pay for the services you're getting. So really thinking about it, because again, all of these different brokers can execute the trades and do that for you. But how much do you want to be involved with it? Do you want to pick the stocks, all of that, or do you want to sit down and have somebody actually give you advice and help you develop an appropriate plan? So again, the cost is going to vary based on which type of broker you go with, but that's one of the first questions you want to ask is what type of broker they are. How much commission are you going to have to pay? What services do they provide for that? So lots of questions to think about. Fraud is relevant, as I'm sure you all are aware. It's everywhere. So if an investment sounds too good to be true, it probably is. So your fraudsters really rely on people who don't bother to investigate. They don't stop to ask the questions. They don't go with that gut feeling. You really want to look at getting written information, prospectus, and I'll tell you what that means in just a minute. And again, if there's quick profits, inside information, any pressure to really invest quickly, it's going to go away if you don't do it tonight. These are all signs of fraud. So you definitely want to check out the person that's selling the investment, even if you already know the person. Don't trust with your money like that. It's gotten a lot of people into trouble. So you want to search for brokers and advisors using the SEC and FINRA databases, and we can post the links to those afterwards so people can have that as a resource as well. If you want to practice investing, maybe you think you're ready to start, but you really don't want to risk some of that money, Investopedia Stock Simulator is a great way to practice. They basically give you $100,000 of pretend money, risk-free. It's free to join, and again, it's virtual cash, so you can really put your trading skills to test against others, so you can compete and see who really does the best investing. So it's one way to really look at that and to kind of get a hands-on experience without really having to worry about losing your own personal money. And then, maybe you get comfortable with it and you do want to try to use some of your own money to do that. So again, a real good option to practice. And the sources of investment information. So again, the prospectus is something you'd want to look at. So it's a formal written offer to sell security that sets forth a plan for proposed business enterprise. So it's going to contain the facts that an investor needs to know to make an informed decision about that company. So whether you want to invest in it or not. The annual report is another really important document that you'd want to look at, and that really details the business activity of that company over the previous year. It has their income statement, their cash flow, their balance sheet, so you can look to see, for example, how red they are. So if they've got a negative net worth, you'll be able to see that in these documents and really be able to know what you're getting into as far as the stance of the company. As far as looking in financial publications, Wall Street Journal, Fortune, Kiplinger's, they all have really good information, as does Finance at Yahoo and Money Central at MSN. Again, real good information sources to look at. And I just wanted to end by going over some good investment habits and some financial missteps for you to avoid. Any investing, any savings requires that you sacrifice some of your income now to be able to invest in your future needs and your lifestyle. So taking some of the money you're making now, setting it aside to be able to save and invest for that future need, for that future lifestyle. And again, starting early in life to invest in a diversified portfolio. So the earlier you can start, the more diversified, the better. And when investing for the long term, willing to accept more risk. So if you're just starting out and you're in your 20s, even in your 30s, and it's for your retirement fund, you can take on more risk right now because you're not going to need that money for a long time. So looking at another 30, 40 years depending on your age. So again, accepting more risk now. Investing regularly through your employer's retirement plan. Again, using an asset allocation strategy, which means you go in every year and you look at that and you make sure the different percentages are still on target where you want it to be. And really thinking about investing no more than 10% of your portfolio in your company stock or any single company stock. When you think about it from your own company stock, lots of employers will give stock frequently for employees as bonuses or have a stock option plan that you can buy and invest in at a lower cost. Well, you work for that employer, so you don't want to have all of your investments tied up into that employer. If that employer goes bankrupt and tanks, your investment and your income is going to go down with it. So not only are you earning all your money from there, you'd be investing there, and that's not a real good strategy. And again, to keep with diversification, you really don't want to have more than 10% of any other company stock. So you wouldn't want to have 50% of one, for example. So again, just really thinking about diversification and asset allocation strategy. Following the buy and hold long-term approach. So buying it and holding it for a period of time. And then looking at the options. So investing in stocks, mutual funds, bonds, and real estate, not life insurance and not annuities. They're not true investment options to get you into the long haul. And when I say not life insurance, I'm talking about your cash value life insurance policies. Much better to buy a term life insurance policy, take the difference, is going to be much cheaper, and you use it to invest, because what they're doing for you is going to be relatively like a savings account. It's really not going to add up over the long haul and going to cost you a lot more money to get there through that. As far as the top 3 financial missteps in investing, so people slip up when they do the following. Invest only money that is left over at the end of the month. Again, we want you to have a budget. We want you to have your debt under control, but you need to think about paying yourself first in that sense. You need to be able to take care of yourself in retirement and later down the road. So you need to make sure you're paying yourself first, putting yourself as a line item in that budget. And if you follow a conservative investment strategy or philosophy for long-term goals, that's not going to work out so well. That's going to be less riskier and less returns. Again, long-term, you want to be more riskier. And fail to regularly rebalance the assets in your portfolio. Again, as the year goes on, stuff shifts around, stuff's sold, stuff's bought, you're putting more money in. Hopefully your employer's putting more money in if you even think about it from a 401k, 403b. So stuff's kind of shifting around, so you want to take that into consideration. So my thoughts, just to kind of summarize: start early. Definitely start early. And again, before you begin investing in individual securities, make sure you're maximizing your contributions to a Roth IRA. And if you have a defined contribution plan through that employer, make sure you're really maximizing that and you're taking full advantage if they're giving you any match money. So you really want to take advantage of that free money. Very few things are free, as I'm sure you're aware, so you definitely want to take advantage of that. So now that concludes my part of the presentation. I'm going to turn it back over to Rita. She's going to give you some announcements about some more exciting presentations that will be coming up for webinars.
While you do that, Marty, and I think I'm all set here, and then we're going to take answers. We're going to answer your questions in a minute. I just wanted to say that if you can't start early, if you didn't start early, start now. It really is never, ever, ever, ever too late to start. And so please do what you can to start making sure that you're putting money aside for the future. Thanks, Dr. Gillen, for that wonderful presentation. It will be, you will all be alerted when that is recording is posted on the website. I did want to point out that this coming Monday, the 30th at 2 p.m., I will be doing a webinar on financial literacy, past, present, and future, and we will be giving away 5 free financial social work certifications, and the cost of the certification is $349. So we have never done this before. I hope you'll join us and possibly win. And everyone who does attend will also, everyone will get a surprise on Monday. In addition to that, I wanted to point out that next month in May on the 22nd, Jessica Sawyer and Anthony Weathers will be doing our May webinar on the financial challenges of addiction, tools to help addicts, their family, and clinicians. So we're looking forward to that also. And at this point, if you haven't submitted your question, please do so, and I will open those up and ask Dr. Gillen to answer them. You will have a survey pop up when we leave the webinar. It's just 4 quick questions. We certainly appreciate your feedback there, and we would hope that you might be interested in getting our money news you need to know now. That's our free monthly newsletter, and we do that twice a month actually, and we give you all the money, most recent money articles from across the internet that we know our community, our students, our graduates would be interested in knowing about. So let me go ahead and see if we have some questions. And if you have a question, you can still submit it to us. So, oh, we do have questions. Let's see.
And I can't see them, so.
Okay. I will share. We have some people excited to be at the webinar and about the ebook. And someone wants to know if we'll be sharing the slides. We will be sharing the recording, so you can watch it at any time. And we have a couple of other recordings of our most recent webinars on the website also. Someone wants to know, is there an association with understanding and level of risk? I think that must mean understanding investing and what you consider your level of risk. Do you want to answer that?
I'm not sure I'm following it. So is there...
If this person, Dolores, if you're still on the line, if you would resubmit that, I'm not sure either. I would think myself that the more comfortable and familiar and knowledgeable that you feel about investing, the higher in your willingness to take risk and
knowledge
invest.
does play into it in some point, but your own personality and emotions. So you may be very knowledgeable, but still very risk averse, just because that's how you are personally, and that's kind of how you're wired. Or maybe you don't really have, enough money that you're willing to risk it, even though you have all the knowledge in the world too. So I think it's bigger than just knowledge.
Sure. Like most other things in life, it's complicated.
Yep, definitely.
Let's see. What are your feelings about online trading tools such as the Ameritrade? I think you kind of answered that, but go ahead if you want to say anything else.
I think if you feel comfortable using it and you want to get in there and try that, that's great. But again, you pay for what you get as far as the online trading tools. You don't get the person that's going to sit down and talk to you. You don't have an office to go into. But, if you want to get in there and try it, I think it's great. Like I said, even with that Investopedia stuff, if you haven't done any online trading, that's a good, really wonderful simulation that's free to practice with too.
I think that's a great resource. I really am so glad you shared it with our attendees. Okay, the next question. What is the best strategy? Okay, so I think that's what is the best strategy for using those online sites, and I think you answered that. Thank you. The information is very helpful. Do you need to register for the drawing? I'm not sure which drawing. If that's referring to the tote bags from today, it was the first 50 people, and so we had way more than 50 people, so that actually took place.
Yeah, that was the first 50 that registered.
Right. And as far as for Monday, the drawing for the 5 free certifications, if you're registered and attend on Monday, you'll be eligible. What time is the webinar? Okay, on 5/22, 2 o'clock is the webinar on 5/22. And that invitation will be posted on the website at the beginning of May. Can Dr. Gillen talk a bit about ETF? Dr. Gillen?
Well, ETF. Trying to think of what ETF stands for.
Okay. I guess you can't. Electronic something.
Oh, are they talking about electronic transfer of funds?
I guess that would be ETF.
I'm not sure if they mean it from an investing standpoint, like I was talking about. You have your paycheck from your employer and you set it up to where so much automatically goes into, say, your 401k, your savings plan. I have a Roth IRA, for example. They take so much every month out of my checking account for that. Is that what they're getting at?
If you're still on the call, would the person that asked the question clarify it, and we will do our best to answer it. Thank you.
Yeah, because I mean, if that's what they're talking about, it's a great option because once you set it up, it's actually more work to get it unset.
Right.
And
well, wasn't the law passed sometime in the past few years that employers automatically put employees into a 401 because for that exact reason, because people were less apt to go ahead and opt into the 401, and when it's automatically done, they're less apt.
For example, at the University of Kentucky, when I left there, once you hit age 30, you were automatically enrolled, and if you didn't fill out the paperwork, you got a nice letter in the mail that said your position would be terminated, basically.
Wow.
You hadn't completed it by a certain date.
Okay.
So, yeah, employers can mandate it.
Personally, I think that's a good thing. Maybe not everyone would agree. Why is life insurance a poor strategy for retirement income?
When you think about life insurance from an investment standpoint, you're talking about doing the cash value versus the term life insurance. And when you look at how much money you actually make on that and the amount that you're paying for the insurance, it doesn't really come out. You could take the difference by the same insurance for term, take a 20, 30-year term policy, whatever term you're wanting to cover, pay a lot less for the insurance, and take that difference and make it work for you by putting it into investing. So it's not that you just take the money and you spend it, you actually have to invest the money.
Okay. And will we be sent a link to Monday's webinar? If you go to financialsocialwork.com, our website, right at the top, there's a red bar, and if you click on that, you can register for that webinar. Will we present the PowerPoint from this webinar to keep? Only as a recording on the website. Will we be able to print this from the slide? No, you can just watch the recording. USAA does discounted trading. Okay. I've enjoyed this webinar. I am looking forward to Monday. Good. The drawing is on Monday. Yes. The 1 in 5 drawing. Yes, that will happen on Monday. No, I think this person with the ETA was talking about extended traded funds. Do you know what that is, Marty?
No.
Okay. Okay, we can't help you with that, regrettably.
Sorry.
Exchange traded funds. Someone suggested exchange traded fund, but the original person, I think, wrote in and said extended traded funds. Okay, we have a few more here. Oh, someone wrote in then. Wow. The question box is so small, but I'm trying to get to all of them. Oh, someone wants the website for Investopedia. You can probably Google Investopedia.
You can.
Simulation.
Yeah. Mm-hmm.
That would probably be the best thing to do. But we should have this posted on our website, and you'll get that email. And so you could go through the recording and see the exact information to log into it. I'm having difficulty finding the ebook for the seminar. How can I access it? I'm not exactly sure. I did mention that I had written an ebook on financial social work, and that will be available to download for free from our website starting sometime in the coming week, if that's what you're referring to. There's no ebook with this presentation. Okay, ETF, exchange traded funds. We have lots of people sharing their information. I enjoyed the speaker today and would like to see other financial and credit speakers in the field. maybe to discuss refinancing and home ownership topics. Okay, there is a spot on the evaluation that will pop up after you leave the webinar when we close it out that asks you for your suggestions on topics, and we will certainly be having guest speakers on debt and credit and other topics in the coming months. Right, refinancing homeowners. I did not get all of the websites offered from the PowerPoint. Can they be given again so that I can? Yes, I can go back to those slides. I'm having difficulty finding the ebook. I don't know. Somehow a bunch of you are looking for an ebook for a seminar. I'm not sure how I delivered a confusing message here. How do you find out if you were among the first 50 to register? Olga is on the line, and Olga, when will you be sending out those emails? Maybe. Go ahead.
Probably today. Yes, today. Tomorrow at the latest, but they should be gone out by tonight.
Okay, so within the next day or so, you'll get the email telling you that you were in the first 50. If you don't get the email, then you weren't. Some people did not give their mailing addresses, so she will have to send a separate email to you because we cannot send it to your email address. Okay.
And I have a little info about the ETFs if you want me to share it now.
Go ahead, ETFs.
Yeah, so it's exchange traded fund is what I've come up with, and it seemed a few people agreed with that in putting in their questions. But I think the person that was asking the question is because they're probably seeing some of this lately that says, is it too much of a good thing? And that some of the brokers have really created some risk by complicating what was considered a simple idea with the ETFs. So basically it's considered like a mutual fund, except for it could be traded throughout the day. And it's kind of looking like they're making them overly complicated, and it's getting a little bit of a riskier type of an investment, and actually says it could be the next source of financial scandal or even, you know, systemic risk.
Not good. So that's probably why we got the question. I think that what you said on one of your slides, and let me see if I can go back up for the people that wanted to, I don't know, let's see if I close this, that wanted to see some of those. I think when I'm looking, if you're still on the call, Marty, I know you had some websites, you know? Am I anywhere?
Which one are you wanting? The ones for the information or the one for Investopedia?
The information, I think.
The information one, you passed it up a minute ago. It is right before the good investing habits and financial missteps.
This one? No.
Keep going. Right there.
Oh, that one? Yeah.
Is that the one they're talking about?
I'm not sure. We'll show that one, and then I'll go. Tell me where the other one is.
Well, the other one had the investing.
Yeah. Where's that?
On it, and you do not have it because I added it late.
Yes, you. Okay.
So literally, if you Google Investopedia, it will come up.
Well, I want to thank everyone for joining us and for staying with us. I know we went a very long time, but we were happy to be able to answer your questions. One last time, someone has asked how to register for Monday's webinar. If you go to our website, financialsocialwork.com, at the very top of the page, you'll see a red strip, and you can click on it and register for that webinar. That's the best way to do it. So thank you, Dr. Gillen. Thanks, Olga, for joining us. And thanks, everyone. I can be reached if you need me at Rita, R-E-E-T-A, at financialsocialwork.com. And we'll see you back here next time. Bye now.